Hello and welcome to the first of two tutorials for Accounting 2208 Chapter 18 Accounting for Taxes. This tutorial will focus on the ABC Company and DEF Company examples, where we will focus specifically on the reconciliation of accounting to taxable income. So in the first question on the ABC Company, make sure that you download or print off the data so that you have it with you, but we will also have it on here on the right-hand side of the screen with the solution on the left-hand side. So we always start a reconciliation. That's what we're doing. We're doing a reconciliation from accounting to taxable income. And we always start with our accounting income as given in our financial statements. So that $450,000 is usually always a given number. Then once we start with our accounting income, we need to have a section that deals with all of our permanent differences. And again, permanent differences are usually items that are either not taxable or not deductible. And so if we look through our data, it is point 5 here, item 5, that has non-taxable dividends. So what would happen is included in the accounting income are dividends of $35,000, but those dividends are not taxable, so therefore they must be removed by deducting it and actually lowering the income by the amount of the dividend revenue that is included in the income statement number. The next permanent difference that we need to add back here, again, one that is not either taxable or deductible, in this case come from data item 2. So there are expenses that are non-deductible for tax, totaling $10,000. These could, examples of such things could be golf club dues, golf dues. What else can we have in there? Interest and penalties, interest plus penalties on provincial or on federal and provincial taxes, federal and provincial taxes, etc. Okay. So this example only has 2 permanent differences, and so once we complete those, we move on to temporary differences, and temporary differences are those items that will eventually reverse themselves, and so that's what we're dealing with here. So one of the most common reversals that you'll see or temporary differences relates to depreciation and CCA. So if we look at item 1 here, so the company deducted $120,000 of depreciation. So included in the income of $450,000 is $120,000 of depreciation, which is not tax deductible. But what is tax deductible is the CCA of $180,000. So what we have to do here is add back the accounting for depreciation. So this will increase the accounting net income, and then this will decrease the accounting net income by the amount that is allowable for income taxes. Then we move on to the next temporary difference. In this case, in data item 4, we have pension. So here, pension expense is recorded before it is funded. Now, in this example, the pension expense is $60,000, but the only amount that is actually deductible for taxes are contributions, or the amount funded. Now, we haven't covered accounting for pensions yet, so we don't need to worry about that quite yet. But suffice it to say that there is a bit of a complex calculation involved in determining what the pension expense is. So the pension expense is non-deductible, but the pension funding, also known as contributions, so that's the amount that gets actually paid in dollars, paid into a plan, paid to a pension plan. This amount is deductible. And so that's why we are deducting that amount and adding back the pension account, the pension expense. The next item we have is data item 3 for installment sales using the accrual method of 40,000. So what happens here is, in this case, from what we can deduce from this information and what's going on here, is because we are using an accrual method and recognizing the revenue, so included in this number here is $40,000 in installment sales, but these installment sales are actually not taxable, so non-taxable until the cash is paid. So not taxable until cash paid. So what's happening is then we are removing that. We're basically saying we're going to deduct $40,000 from the accounting income so we don't end up paying tax on it. The tax will become payable when we actually receive the cash. And now the last item in our reconciliation is item 6 here. And this has to do with some security investments that were accounted for using fair value through net income. And adjusted at the end of the year to fair value. Now, basically the adjustment that we have here for $6,000 is not taxable. See, what happens with investments are taxable in different ways, and the calculation for how those investments are taxed is a little bit more complex. It relates to if it's a capital gain, and only 50% of the gain is taxable. But we don't account for investments the same way we do for taxes. And so this adjustment of $6,000 for an unrealized loss is included in this $450,000. So we're saying that our income is now too low by the tune of $6,000, and that $6,000 is actually not deductible. So we are increasing our accounting income by the amount of the loss that is not deductible. So now once we take our accounting income and we add back our net permanent differences, so again we are deducting the non-taxable dividend, adding back the non-taxable expenses, then we move to our temporary differences, so our depreciation CCA, which further reduces our taxable income by $60,000. And then we are having to add back this non-deductible pension, but deducting what we can for taxes, so we're able to actually lower the income tax. Because the $60,000 is not deductible, then we have to actually increase our taxable income to compensate for the amount that we're actually not allowed to deduct. Then we have the installment sales that are non-taxable, as we discussed, so we don't want to pay tax on something that isn't taxable yet. And then the unrealized loss, which is not deductible. So that gives us taxable income of $371,000. And then the rest is easy. Once we have our accounting income, taxable income of $371,000, we use a 30% tax rate, and this gives us our current year income tax expense. And then our last objective here is to journalize that expense, so we're always going to debit the current tax expense, and we will credit current taxes payable. We'll make sure that we don't confuse these items with deferred or future taxes. Okay? So that basically ends the ABC company example. Remember, we are not going any further in this tutorial to calculate the actual future taxes. We're just focusing on the reconciliation of accounting to taxable income, and that's what we've done. And now we will continue with the second question in the reconciliation of accounting to taxable income example. So here is our data for DEF, starting with the accounting income and then all of the various additional items which we will reconciled to taxable income. So as with the previous example, we always start with their accounting income, so that's where this $260,000 comes in. Then we include our permanent differences, and so if we look through the list, the rent is a temporary. If we list, this is a temporary difference. The warranties are temporary differences. CCA and depreciation are temporary differences. But when we look at something that is not taxable or not tax deductible at all, then this is a permanent difference. Okay. And what we have here are life insurance proceeds. Now, life insurance proceeds are not taxable to a family. Let's say you have a parent or a spouse that unfortunately passes away and you have life insurance on them. The life insurance proceeds are not taxable, but at the same time, the insurance premiums are not tax deductible. So the company here will get a $55,000 basically tax-free amount, but the premiums that they paid over the years to protect themselves against the death of a key officer are not deductible. So that's what happens here. We are having to deduct the life insurance proceeds that are not taxable. Okay. And so that has the effect of lowering our income, right? And that is the only permanent difference. So all the rest, if we go back, this is temporary, 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 permanent, temporary, temporary. And then we can go in any particular order we like here. It's up to you how you proceed. Sometimes it's just easiest to do the ones that you always know usually are going to be there. So item 3 is a difference of depreciation versus CCA. So you can get questions worded a little bit differently. In the previous one, we told you how much the depreciation was and how much the CCA was separately. In this case, you're told what the excess of CCA over depreciation is. And so all we know is that CCA was greater than accounting depreciation. So we could make up a number here, and we could say that accounting depreciation was $15,000. And we could say that CCA was $20,000. Sorry, $20,000. And that would give us a net difference of $5,000. And so that's the amount that we're going to deduct here. Our next temporary difference in this example is a little different. Here we have warranty expenses. In the previous example, we had pension costs. Well, warranties are treated in the exact same way conceptually as pensions, because what happens is warranty expense, which is usually an estimate, is not tax deductible. But what is deductible are the warranty costs, right? So actual costs, warranty costs are deductible. And so what we're saying here is that the company would have debited its, and if you may remember the journal entries and accounting for warranties, there would have been a debit to warranty expense for $60,000 and a credit to warranty liability for $60,000. Right? That's how that arrives. So this warranty expense is not tax deductible, but the costs are. So we end up having to increase. See, what this does is it increases our income by the non-deductible amount, or the difference between the warranty expense and the actual amount we're allowed to deduct. So our income is going to go up because of this adjustment. The next item pertains to a lawsuit here. In our example, the losses on the lawsuits are $75,000 and will be deductible in the period that it's settled. Okay, it's very common for companies based on there are certain conditions to be met when it comes to things called contingent liabilities. But what happens here, the lawyers may say, well, we think that you're going to have to pay $75,000. And so what happens then, you will actually accrue an expense of $75,000. But again, the government does not allow estimates, right? Estimates are non-deductible. So whatever you estimate on your financial statements for contingent liability related to lawsuits is fine, but that cannot be deducted for tax purposes. When the final lawsuit is settled, and it could be $70,000, $50,000, $120,000, the full amount of the settlement is deductible and would appear in this section, the temporary difference section, later on in the future when it actually happens. We're almost done here. The next item is rent. So the company has rent that is collected in advance. Now, rents are taxable in the period when they are received. So if we think of rent or other amounts paid in advance, this could be treated for accounting purposes as unearned revenue, right? And so you'll want to maybe review your understanding of unearned revenue. Right, so you will happily take money in advance from your customer, but you cannot record it as earned until you've actually earned it. Now, what happens is, for accounting purposes, right? They may say, well, it doesn't matter in what accounting period they're actually earned. That amount is taxable when you actually collect it, and so we are increasing our income here by the amount of the rent that was collected in advance, even though it may not be recognized as revenue or income for accounting purposes. And then the last item here has to do with impairment loss on goodwill. This is a special situation when it comes to goodwill is not, any impairments on goodwill are not tax deductible. Once goodwill is recorded, goodwill is actually amortized over a very long period of time. You'll take a tax course and you'll see what happens there. But basically, any impairments on goodwill are never deductible, and this temporary difference will take a long time to reverse because the goodwill is actually amortized on a straight line basis, no, on a declining balance basis over a long period of time. And so we can now arrive at our final number for our taxable income, starting with our accounting income of $260, deducting our non-taxable life insurance proceeds because we don't have to pay tax on that. We can deduct the amount of CCA that was taken off over depreciation. Remember, the fully deductible amount is CCA. So if you go back to the numbers I used before, it may make more sense to say, well, I'm going to add back $15,000 in depreciation, but then take off $20,000 in CCA, but the net is still $5,000. We have to add back and increase our income by the amount of the non-deductible warranty expense. We're increasing our income by the lawsuit, which is an estimate. We're not allowed to deduct estimates. We have to increase our income by the rent that's collected in advance and taxable when collected. And we have to increase our income by the amount of the goodwill impairment, which is never deductible. It's not a permanent difference because goodwill is still amortized and there is a tax benefit that can be claimed for that, but it just takes a long period of time. And so the taxable income is $351,500. And then if we multiply by our tax rate of 28%, we end up with a current year tax expense of $98,420. And then our final journal entry, again the same as with ABC Company, a debit to the current tax expense and a credit to the payable of $98,420, and we're finished. So this concludes tutorial 18.1 on reconciling accounting to taxable income. Hope you found it useful, and move on to the next tutorial when you're ready.